Okay, let's be real for a second. The term audit evidence, it sounds kinda dry, doesn't it? But what if I told you that getting a handle on this one concept is probably the single most important key to not just passing, but absolutely acing your CA exams? Today, we're going to pull apart SA 500 and show you exactly why it's the foundation of every single audit you will ever perform.
All right, let's dive straight into a scenario you're definitely going to face in your articleship. Picture this. You've spent hours, maybe days, checking 1,000 sales invoices. Every single one is perfect. It matches the system, the delivery note, everything. So you can confidently say the company's total sales figure is correct, right? Well, maybe not. And understanding why is the secret to unlocking what audit evidence is all about.
And this brings us to Samir, an articleship student probably a lot like you. He's watching his seniors, checking invoices, sending out bank confirmations, and it gets him thinking, what actually makes a piece of evidence good? Is evidence from outside the company automatically better? These aren't just classroom questions, guys. They're the real-world problems you have to solve. And today, we're going to answer every single one.
So, what's our game plan? This here is our roadmap. We're going to start with the absolute core concept of audit evidence, and then we'll branch out into all the different ways we can get our hands on it. But for now, let's zoom in on that first box and really nail down the fundamentals.
Right. Let's kick things off with the big picture. Why on earth is there an entire standard on auditing just about evidence? Why is this such a massive deal?
Here's the most important thing to remember. Your audit opinion, that final true and fair view statement, it's not a hunch, it's not a guess. It has to be built on a solid, concrete foundation. Because if you give an opinion without that foundation, it's not just unprofessional, it's straight up negligent. You could get into serious trouble. And that foundation, that solid ground you need to stand on, is your audit evidence.
Which brings us right to the heart of it all. Standard on Auditing 500, audit evidence. The entire point of this essay is to tell us how to get sufficient, appropriate audit evidence. Now, those two words, sufficient and appropriate, I want you to burn them into your brain. We're going to be coming back to them again and again.
So what exactly is it? Well, according to SA 500, audit evidence is basically all the info you use to come up with your final opinion. But look closely here. It says information from accounting records and other sources. That's a huge point. It's not just about the numbers in the T accounts.
Let's break that down a bit. On one hand, you have accounting records. Yeah, this is the obvious stuff. Invoices, contracts, the general ledger, bank transfer records. The nuts and bolts of the financial statements. But then you have this other bucket, other information. This is just as important. We're talking about things like minutes from board meetings, written confirmations you get back from banks, and even the company's own internal control manuals. It's all the stuff that gives context to the numbers.
And here is a massive exam tip for you straight from the ICII material. Just think about illustration 1. The link is direct. It's non-negotiable. Your audit opinion is the house, and the audit evidence is the foundation. If you don't have the foundation, you can't build the house. No evidence, no opinion. It's that simple.
Okay, so where does all this information come from? Well, we can basically split it into two big categories. You've got internal evidence, which is anything created inside the company you're auditing, like their own sales invoices or stock sheets. And then you have external evidence, which comes from outside the company, like an invoice from a supplier or a confirmation letter from their bank.
Okay, everybody listen up. IKI Trap Alert. This is a classic exam question. Which one is more reliable? The answer is always external evidence. But, and this is where students lose marks, you can't just say that. You have to explain why. And the magic word is independence. External evidence comes from a third party who doesn't really care about the company's financial results. That makes it way harder for the company to manipulate or influence it. You have to explain the why to get full marks.
So, we know what evidence is, and we know where it can come from. But here's the thing. Not all evidence is created equal. This brings us to the quality of the evidence. And we measure quality using two ideas, relevance and reliability. First up, relevance. This just means your evidence has to have a logical connection to what you're trying to prove. This is where the idea of direction of testing becomes super important. For instance, if you're worried a company has overstated its payables, you would look at the payables they've recorded and check the proof. But what if you're worried they've understated them, meaning they've left some out? Well, checking the ones they've already recorded won't help you find the missing ones. Instead, you'd have to look at payments made after year-end or unpaid invoices to see if they should have been included. See? The direction you test from makes all the difference to whether your evidence is relevant.
Next up is reliability. This is all about how trustworthy the evidence is, and there are 5 rules of thumb here that you absolutely positively have to know for your exams. 1. Independent external sources are more reliable than internal ones. We just talked about why. 2. Evidence from inside the company is more reliable when their internal controls are really good. Makes sense, right? Good controls mean fewer mistakes. 3. Evidence you get directly yourself is way more reliable than getting it passed through the client. No chance for them to change it. 4. Written evidence beats spoken evidence every time. It's on paper, so it's harder to deny later. And 5. Original documents are more reliable than photocopies or faxes. It's just tougher to fake an original. Seriously, this list is pure gold for exam questions.
Okay, so we've just spent a lot of time talking about the quality of our evidence. But that leads to the next obvious question. How much of it do we actually need? And this brings us back to our 2 favorite words, sufficiency and appropriateness. Let's get these definitions crystal clear. Sufficiency is all about the quantity of evidence. It answers the question, how much? Appropriateness, on the other hand, is the measure of quality, and it's actually made up of those 2 things we just discussed, relevance and reliability. It answers the question, how good is it? They are 2 sides of the same coin. And please do not make this common mistake. The ICAI material specifically warns us about this in illustration 3. Students sometimes confuse sufficiency with simplicity or appropriateness with how easy it is to get. No, that is completely wrong. Don't fall for that. Sufficiency is quantity. Appropriateness is quality. Full stop. Now here's the cool part. These 2 ideas are totally connected. In fact, they have an inverse relationship. Think about it. If the evidence you're getting is super high quality, really appropriate, you probably don't need as much of it. But if the evidence you're getting is kind of weak and low quality, you're going to need to gather a whole lot more of it to feel confident. So we have quality and we have quantity. And we know they're connected. But the million-dollar question is still hanging in the air. How do you actually decide what is sufficient and appropriate? Well, there's no magic number. There's no perfect formula. It all comes down to the auditor's professional judgment. But that judgment isn't just a wild guess. It's shaped by some really key factors. First, materiality. If an account balance is huge and very important, you're going to need more evidence for it. Simple. Second, the risk of material misstatement, or RMM. This is your assessment of how likely things are to be wrong to begin with. If you think the risk is high, you need more evidence to bring that risk down. And third, the size and nature of the population you're testing. Obviously, you'll need more evidence for a company with 10,000 transactions than one with 10. And this all leads us back to the ultimate goal. Why do we do all this? Why do we care so much about getting sufficient, appropriate audit evidence? The entire purpose is to reduce audit risk, the risk that we might give the wrong opinion, down to an acceptably low level. That is the whole point of the audit. You know, in every single CA exam, there's a type of question that seems almost too simple, and it's a classic ICAI trap that catches so many students out. It really tests the absolute bedrock of what we do as auditors. Let's see if you can spot it. So think about it for a second. You ask the question, you get a yes. Is that it? Job done? If you're thinking, yeah, that sounds about right, or even if you're a little unsure, then these next few minutes are going to be absolutely crucial for you. Because the real answer is a hard no, and understanding exactly why is the key to mastering this entire chapter on audit evidence.
Okay, let's get right into it. Look, at the end of the day, our entire job is to form an opinion on the financial statements. But here's the thing. An opinion without solid evidence is, well, it's just a guess. And we are not in the business of guessing. So today, we're going to build the exact framework you need to gather that evidence the right way.
All right, first things first. Let's get our heads around the overall structure of how we go about gathering evidence. It's not a random hunt. It's a really systematic process.
Now, take a look at this. This flowchart is basically our entire game plan on one page. Every single thing we do to get audit evidence fits into one of 2 major buckets. So let's break down this top level.
So it all boils down to this 2-step process. First, we perform what are called risk assessment procedures, or RAP. This is all about reconnaissance. We're trying to understand the client, their business, their controls, and basically figure out where are the fires most likely to start, where can things go wrong. Once we pinpointed those risks, we move to step 2, further audit procedures, or FAP, which are designed to directly respond to the specific risks we just found.
And these further audit procedures, or FAP, they split into 2 distinct paths. First, you've got tests of controls, what we call TOC. Here, we're checking the process. We're asking, are the company's internal controls actually doing what they're supposed to be doing? The second path is substantive procedures. Here, we're checking the numbers. We're digging directly into the figures on the financial statements to hunt for any major errors. So remember it this way. TOC checks the system, substantive checks the output.
Okay, so we've covered the why and the what. Now it's time for the how. Let's look at the actual tools we use to do all this stuff. The RAP, the TOC, and the substantive procedures. This is our toolkit.
And here they are, your 7 fundamental audit procedures. You've got to know these inside and out. We've got inspection, observation, external confirmation, recalculation, reperformance, analytical procedures, and of course, inquiry. Let's take them one by one, starting with inspection.
Inspection is pretty much exactly what it sounds like. You're examining things, records, documents, or even physical assets. This could be anything from reading a sales contract to checking a purchase invoice, or even going to a warehouse to physically see and touch the client's inventory. It's an incredibly versatile tool. Okay, quick pop quiz. Based on what we just said, what procedure are we talking about here? It's a really straightforward application.
Yep, you got it. It's inspection. And listen up, because this brings up a hugely important limitation. A classic exam point. If you go to a factory and you see a big machine, that inspection gives you fantastic evidence that the machine exists. But, and this is a big but, it doesn't prove the company actually owns it, right? It could be on lease, and it definitely doesn't prove that its value in the account books is correct.
All right, next up, observation. This one's simple. You're just watching a process as it happens. The textbook example is attending the client's year-end stock count. But what's the big catch here? Well, people tend to behave a little differently when they know the auditor is watching, right? So the evidence you get is only valid for that specific moment you were looking.
Now, external confirmation. This one is a beast. It's super powerful because the evidence comes directly to us, the auditor, from an independent outside party, like a bank confirming a balance or a customer confirming how much they owe. This makes it really, really reliable. We also use it to confirm tricky contract details or even to ask if there are any secret side deals that aren't in the main agreement.
Okay, I need you to lean in for this one because this is a spot where so many marks are lost. Recalculation versus reperformance. Recalculation is simple. You're just checking the math, adding up the numbers on an invoice, checking a depreciation calculation. That's it. Reperformance is different. This is where you, the auditor, independently redo a control that the client was supposed to do. So checking the addition on their bank reconciliation, that's recalculation. Doing the entire bank reconciliation yourself from scratch to see if you get the same results, that's reperformance. Huge difference.
All right, let's round out our toolkit with the final 2. First, we have analytical procedures. This is all about being a detective and looking for weird trends or relationships in the financial data. Like, if a company's sales shoot up by 50% but their cost of sales stays exactly the same, that's a red flag you'd want to investigate. And last but not least, we have inquiry, which is, you guessed it, simply asking questions. And that brings us right back to our very first question.
And here it is, the punchline. This is the single biggest exam trap in this whole area. ICI tests this again and again and again. Inquiry is a fantastic starting point. It helps you understand things, but it is almost never enough evidence on its own. Why? Because the information comes from inside the company, and it could be biased. You always have to back it up, corroborate it with another procedure. It's the start of your work, not the end of it.
So we've got our tools, we know what they do, but knowing the tools is one thing. Knowing the tricky spots, the little nuances that separate a good answer from a great one in the exam, well, that's what we're talking about now.
First up, and this is a big one, context is absolutely everything. The very same procedure, let's take inspection, can be a RAP, a TOC, or a substantive procedure. It all depends on why you are doing it. So if you inspect a sales invoice just to understand their billing process, that's a risk assessment procedure. If you inspect that same invoice to check for a manager's signature, that's a test of control. And if you inspect it to verify the final amount, that's a substantive procedure. Same action, 3 different purposes. 2 other quick things. You can use evidence from last year's audit, but you can't just copy-paste. You have to do some work this year to make sure it's still relevant. And finally, remember that in today's world, some electronic data gets deleted or archived, so you might need to time your audit work to make sure you can actually get the evidence you need before it disappears.
Okay, so we've got the process, we've got the tools, but what exactly are we aiming at? What are we trying to prove or disprove? That, my friends, is where assertions come in.
Think of it this way. Every single number, every single disclosure in a set of financial statements is basically a claim being made by management. When the balance sheet says fixed assets 10 crores, management is implicitly asserting a few things, that those assets actually exist, that the company owns them, and that 10 crores is their proper value. Our entire job as auditors is to gather evidence to test these claims.
So for transactions that happen during the year, like sales or purchases, we test 5 main claims. Occurrence, did the sale actually happen, or is it fake? Completeness, have all the sales that really happened actually been recorded? Accuracy, are the amounts and calculations on the invoice correct? Cutoff, was the sale recorded in the right financial year? And finally, classification, was it recorded as revenue and not, say, something else?
Now, for account balances, the stuff sitting on the balance sheet at year-end, like inventory or debtors, the claims are a bit different. Existence, does that pile of inventory physically exist in the warehouse? Rights and obligations, does the company truly own that inventory? Completeness, has all the inventory they own been included in that final number? And valuation, is it recorded at the correct amount following the accounting standards?
And finally, we can't forget the notes to the accounts. Even here, there are assertions. We check if the events they describe actually happened, if all the necessary disclosures have been included, if the information is presented clearly so people can actually understand it, and if the numbers and values inside those notes are accurate.
All right, enough with the theory. Let's connect the dots. We need to connect our tools to our targets. This is exactly how you'll need to think to solve problems in the exam.
Okay, here's a classic exam-style scenario. You're looking at the aging schedule for trade payables, and it's in the notes to the accounts. What specific claim, what assertion by management are you really testing here?
The key phrase here is notes to accounts. The second you see that, you should be thinking about the presentation and disclosure category of assertions. And when you're checking the aging schedule, you're verifying that the financial data, the breakdown of how old the payables are, is disclosed fairly and at the right amounts. That falls squarely under the accuracy and valuation assertion for disclosures.
All right, let's bring it all the way back home to the question we started with. C.A. Soria Gaithry asked the accountant about bank reconciliations, and the accountant said, yes, we do them. Is her test of control complete? Is that enough?
And the answer, as we now know for sure, is absolutely not. No way. We've hammered this point home. Inquiry is just the starting gun, not the finish line. To get sufficient, appropriate evidence, she needed to follow up. She could have asked to see the completed bank recs for a few months. That's the procedure of inspection. Or, for even stronger evidence, she could have picked a month and redone the BRS herself from scratch to see if she got the same result. And that's reperformance.
Essay 610. It's all about using the work of internal auditors.
Imagine this. You're the external auditor, you're up against a deadline, and you find out the company has this fantastic internal audit team that's already done a ton of work. Your first thought is probably, yes, I'll just take the report, it'll save me so much time, and I can cut down on my own checks. But can you really do that? Is it that simple? This is a huge misconception, and trust me, ICAI loves to build questions around this. The answer isn't a simple yes or no. It's way more complicated.
Okay, let's get into it. Section 1. First things first, we need to be absolutely clear on what we're even talking about. What exactly is an internal audit function? And as the external auditor, what choices do you have when you find one?
So here's the official definition, straight from the standard. The key words you really want to remember are evaluate and improve. Think of the internal audit function as the company's own health check system. It's there to check and make the company's governance, risk management, and internal controls better. You know, this definition is a perfect way to start an exam answer on this topic.
So what does that mean in the real world? Well, their work usually falls into 3 big buckets. They look at governance, ethics, how the company is run. They're involved in risk management, which could even include things like fraud detection. And, this is the big one for us, they work on internal controls. They evaluate them, they test them to see if they're actually working, and they check if the company is following all the rules and regulations. Okay, now this slide is super important because it lays out your 2 very distinct options as an external auditor. Option 1 is using the work they've already finished, their reports, their findings. Option 2 is totally different. It's asking the internal auditors to work for you under your supervision, almost like they're part of your team for a little while. And these 2 paths have very different rules.
Before we go one step further, let's get this crystal clear. This is the golden rule. It is absolutely non-negotiable. No matter how much you rely on the internal audit team, no matter how much help they give you, at the end of the day, that final audit opinion is your responsibility, yours and yours alone.
You can't turn around later and blame the internal auditors if something goes wrong. All right, so you've established there's an internal audit function. Great. But you can't just dive in and start using their work. You absolutely must evaluate them first. And listen, this section is critical. In an exam, if you just start talking about using their work without explaining this evaluation process first, you're just throwing marks away. This is where people lose them.
So, what's the evaluation? It's a mandatory 3-step process. You have to check their objectivity, you have to check their competence, and you have to check if they have a systematic and disciplined approach to their work. Just remember OCS: objectivity, competence, systematic approach.
Let's break that OCS down. For objectivity, you need to ask, who do they answer to? Is it the board of directors or some mid-level manager who could pressure them? Do they have other jobs that conflict with their audit role? For competence, you're looking at their skills. Are they qualified CAs? Do they have the right training and experience for the industry? And for the systematic approach, you're basically checking their process. Is their work well planned? Is it documented? Is there a review process? Do they have quality controls? These are the exact questions you need to be asking.
And this brings us to the absolute red lines. Another exam trap. If you do your evaluation and find that their objectivity is shaky, or they just don't have the skills, or their work process is a total mess, the standard is crystal clear. You cannot use their work. It's a full stop, a no-go. You just have to do everything yourself.
Okay, so let's say the internal audit function passed your OCS quality check with flying colors. What happens now? Well, that opens up path number 1, using the work that they have already completed.
So, what kind of work are we talking about? The standard actually gives us some really good examples. Things like they're testing on internal controls, or maybe they observed the year-end inventory count, or maybe they trace transactions through the IT system. Do you see the pattern here? Most of these are tasks that don't require a massive amount of professional judgment.
And that leads us to this slide, which is incredibly important. Seriously, this is where the marks are in the case studies. Relying on internal audit isn't an on or off switch. It's a sliding scale. The more judgment an area needs, or the higher the risk of material misstatement is, or even if they passed your evaluation, the weaker their objectivity or competence is, the less you rely on their work, and the more work you have to do yourself. You have to constantly make that judgment call.
Okay, let's shift gears and talk about path number 2, getting direct assistance. This is where you ask the internal auditors to actually perform specific audit tasks for you. And because they're essentially working under your banner, the rules here get a lot stricter.
So first, what does direct assistance actually mean? It means they are performing audit procedures for you, and you are in charge. You give them the directions, you supervise what they're doing, and you review their work papers. For all intents and purposes, they're a temporary extension of your audit team.
Now pay close attention, because this is a huge mark-scoring area. There are some things you can never, ever delegate to them, even if they're providing direct assistance. You can't ask them to work on areas that need significant judgment or where the risk is really high. You also can't ask them to check work that they were already involved in for the company. And obviously, you can't ask them to help you decide whether or not to use the internal audit function in the first place.
And before you can even start using them for direct assistance, there are 2 pieces of paper you absolutely must get. First, you need a written agreement from the company's management promising that they won't interfere with the work that the internal auditor is doing for you. Second, you need a written agreement from the internal auditors themselves saying they'll follow your instructions and keep everything confidential. Without both of these agreements, you cannot proceed.
So whether you're on path 1 or path 2, you need to make sure everything is coordinated properly. And throughout it all, you have to remember who is ultimately calling the shots.
You know, good coordination is just common sense. You need to sit down with the internal audit team and discuss everything. The timing of their work and your work, the exact nature of the procedures, the extent of coverage, even technical things like materiality levels and how you're both selecting items to test. It all needs to be planned out to make sure their work is actually useful for your audit and you're not just duplicating effort.
All right, enough theory. The most important part is being able to apply all this knowledge. So let's walk through a classic ICI-style question and see how these pieces all fit together in practice.
Here's the situation. You discovered that the head of internal audit reports to the CFO, a mid-level manager, not directly to the audit committee or the board. To make things more complicated, the area you're looking at has a high risk of material misstatement. So the question is, can you rely extensively on the work they've done in this area? What do you think?
The answer is a clear and definite no. And here's how you'd structure that for full marks. First, you point out that reporting to a mid-level manager threatens their objectivity. Why? Because they might feel pressured to not report issues. That's one red flag. Second, the RMM is high. And what did we learn from our sliding scale? When risk is high, our reliance must go down. So, because of these two factors combined, SA 610 requires the external auditor to reduce their reliance and perform more of the audit work themselves. See how you link the facts directly back to the standard? That's the key.
So, to wrap it all up, the best way to think about SA 610 is like a decision tree. Your first step always is to run that three-point check: objectivity, competence, and systematic approach. Only after you've done that can you decide which path to take, and more importantly, how far down that path you're willing to go. Your professional judgment is everything here, but never, ever forget, the final responsibility for that audit opinion rests with you.
Two standards on auditing that are packed with marks, but also packed with traps that ICAI loves to set. We're talking SA 510 on opening balances and SA 550 on related parties. Let's make sure you're ready for them.
So picture this. You've just been appointed as the new auditor for a company. The firm before you did the audit last year, signed off on everything. So the big question is, can you just take their word for it on the opening balances and focus on what happened this year? What's your gut feeling?
And if you thought, yeah, that sounds reasonable, well, that's exactly the trap ICAI wants you to fall into. The real answer, the one that gets you the marks, is a huge, definite no. And you absolutely have to understand why. To really get this, we're not just going to read theory. We're going to tackle a classic exam problem, step by step. So let's introduce our case study, CA Pankaj. His situation is going to teach us everything we need to know.
Okay, let's start with Section 1, the classic ICII trap, starring our friend CA Pankaj. Seriously, this is exactly how they frame questions in the exam.
So here's the deal. CA Pankaj gets the audit for ABC Limited. He's new. Someone else audited last year's books. So Pankaj argues, hey, that's already been checked. I don't need to waste time on the opening numbers. And the exam asks you point blank, is he right?
To answer that question properly, we need to pull out our first tool from the auditing toolkit, and that is SA 510, which is all about initial audit engagements and, you guessed it, opening balances.
First off, we've got to understand this term, initial audit engagement. You might think this only means the company's first ever audit, but look at point number 2. It also counts if the prior year was audited, but by someone else, by a predecessor. So right away we know that CA Pankaj's audit is, by definition, an initial audit engagement.
Now, because it's an initial audit, SA 510 gives you a very clear objective, and this part is absolutely crucial. You, the new auditor, have a direct responsibility to get enough evidence on two things. One, that the opening balances are clean and aren't hiding any mistakes that could mess up this year's numbers. And two, that the accounting policies from last year are being used consistently this year. Your signature means you checked, not that you trusted the last guy.
So what do you actually do? The standard tells you exactly what's expected. You read last year's financial statements and the old audit report. You do the basic check. Did last year's closing numbers actually become this year's opening numbers? You make sure the accounting policies seem right. And then, step 4, and this is the big one, you perform your own specific procedures to get evidence. You might review the old auditor's work papers, or maybe you can verify an opening balance by looking at activity in the current year. You might even have to do some brand new tests yourself.
Okay, now this table, this is where so many students lose easy marks, so pay close attention. ICAI loves to test this. It's all about the consequences. If you just can't get enough evidence on those opening balances, that's a limitation on your scope. You either qualify your opinion, or, if it's really bad, you issue a disclaimer. But if you find a definite mistake, or the accounting policies are all messed up, that's a finding. That leads to a qualified or even an adverse opinion. You have to know which situation leads to which report. All right, we've got a handle on opening balances. But auditing's never that simple, is it? Let's add another layer of risk that you'll find in almost every audit: related parties. This is all covered in SA 550. So first, who even counts as a related party? Well, SA 550 gives us a two-part answer. Your first stop is always the main rulebook, the financial reporting framework, like AS 18. But what if those rules are weak or don't exist? Well, the standard has a backup definition that catches anyone with control, significant influence, or who is under common control. It's a safety net.
So why the special treatment? Why a whole standard? Because these transactions are a huge red flag for potential misstatements. I mean, think about it. The relationships can be super complex, maybe even deliberately confusing. The company's own accounting software might not even be smart enough to catch them all. And here's the kicker. The deals might not be at a normal market price.
You could have a sale with zero payment just to move profits or hide losses.
Okay, so we know it's a high-risk area. The standard doesn't just point out the problem and leave you hanging. It gives you a clear action plan. Let's walk through the procedures you need to follow under SA 550.
Your very first step is to talk to management, but you can't just casually ask, "So, any related parties?" No way. You have to be specific. You need to ask for the identity of every single one, the nature of how they're all connected, and the type and purpose of any deals done with them. You need the full picture. Next, you gotta play detective. You need to investigate what systems the company itself has in place to handle this risk. How do they even find and report these transactions? Who has the power to approve big deals with related parties? If management has weak controls or none at all, your risk assessment for the audit just shot through the roof.
Now, auditing isn't a one-size-fits-all job. The way you handle related parties in a small family business is going to be totally different from how you do it at a massive corporation. Let's look at this special case for smaller companies.
Just look at the difference here. In a small company, you're not going to find a big fancy manual on related party policies. The owner is probably involved in every single decision, so your audit approach has to adapt. You can't test controls that don't exist. Instead, you'll be doing a lot more direct questioning, observing the owner-manager in action, and inspecting whatever documents you can get your hands on.
All right, we've gone through SA 510, we've gone through SA 550. We have all the pieces of the puzzle. Now, it's time to go back to the beginning and put together that perfect, full marks answer for our friend CA Pankaj.
So let's ask it one last time. You're in the exam hall. You've got the question in front of you. Is CA Pankaj correct when he says he can skip the work on opening balances just because another auditor was there last year?
The answer, without a shadow of a doubt, is no. CA Pankaj is completely and totally incorrect. His argument is invalid. Why? Because as per SA 510, his appointment is an initial audit engagement. And that standard explicitly requires the new auditor to perform their own procedures on opening balances. Looking at the predecessor's work could be part of it, but it never, ever replaces it.
Okay, before we wrap up, let's nail down the key takeaways for your exam. Number 1, in an initial audit, you must verify opening balances, period. That's SA 510. 2, trusting the predecessor is not an audit procedure. Don't even think about writing that. 3, related party deals are always high risk. That's your mindset from SA 550. 4, because of that risk, you must ask management about their controls. And 5, remember to change your approach for small companies versus big ones. Burn these 5 points into your brain.
And let's end on this. This is the core idea behind everything we've talked about today. When you sign that audit report, that's your signature. It's based on your work and your evidence. It is your responsibility and you can't pass it off to anyone else. Remember that and you'll be in great shape.